Hi friends, welcome to Navkar Digital Institute, India's first virtual learning platform for professional coaching. Friends, I believe we understand the importance of RTPs, MTPs and past papers. I mean, they carry a lot of weightage. Actually, they are useful from two perspectives. Number one, it gives you an idea about trend, and specifically when you refer last 5 attempts RTPs and MTPs and past papers, you understand the trend in which the questions are going to come in your exam. And more important, after preparation, when you solve RTP, MTPs and past papers, it boosts your confidence, because RTP, MTP and past papers are the ideal papers, or rather the actual papers which have been either asked in exam or has been released by ICI, that they are something, this is something which is what they are going to ask in your exams. But you know friends, where the problem is, like they have released one of the RTP in May 18. Now when May 20 students are referring those RTPs, the point is, what about the amendments? What about the changes? What about the components which has been modified? You know, in India, a lot of faculties have released lectures of RTP May 18, but they have recorded that at that time when RTP of May 18 actually was issued by ICI. Friends, that's where Navkar, the NDI, is taking an initiative. What we are doing is, respective RTPs and MTPs, we are amending as per the relevant attempt, and now we are in process of releasing the amended RTPs and MTPs. So today, when in June 20, I am recording the RTP, I am obviously recording RTP of May 20, but I am also recording RTP of May 18 as amended for June 20 attempt, or let's say as amended for November 20 attempt. So I hope you understand the importance of amended RTPs and MTPs, and for that you can rely only on one institute, and that is NDI, which is Navkar Digital Institute. Yes friends, we are the only one who is providing amended RTPs and MTPs for your attempt. So stay with us, stay home, stay safe and stay healthy. Thank you and God bless you.
Hello my dear friends, after completion of discussion about RTPs and also mock test papers, it's time now to talk about the past exam question papers. And when I talk about past exam question papers, we will go in the order of, we will first complete November 2019, then we will talk about May 2019, then we will talk about November 2018, and also then talk about May 2018. In this series, we will also complete the discussion about past exam papers also. So far we have seen questions on revision test paper, and we have also seen questions from mock test paper. But now we are going to see questions from actual exam question papers of ICAI. Clear friends? So far what we have done were only mock test papers and revision test papers. So now we are starting discussion about the actual past exam question papers of ICAI. And let me tell you very clearly, November 19 paper and May 19 paper will not take much time for us, for a simple reason and fact, because we are going to talk only about 70 marks. Why only 70 marks? Because 30 marks weightage is being given for multiple choice questions. And ICAI has not released what questions have come in the exam for multiple choice. So they have not released that question paper outside at all. So only the students who wrote the exam knows what answers they wrote. That's it. But the question paper is not released outside, and students were given separately that 30 marks question paper for multiple choice, and they were required to circle through OMR sheet. That is where this 30 marks content of the paper was not released by ICAI outside. So no student is carrying the 30 marks questions which were come for multiple choice. So still no problem. We'll spend some very good time on discussion about the descriptive part of 70 marks. Clear friends? So first we'll start with discussion about November 2019 paper. Are we ready friends? It will not take much time because we are going to talk only about 70 marks. That's it. Clear? Are we ready sir? Done. Let's proceed. Let me start discussion about a wonderful paper called November 2019. Done. Moving forward, friend, this is your paper for final new syllabus, old syllabus, November 2019. You can see very clearly question paper comprises of part 1 and part 2. Part 1 comprises of multiple choice questions, and part 2 comprises questions which require descriptive type answers. Ensure that you receive ensure that you receive question papers relating to both the parts. Fifth point you read once, sir. Answer to questions in part 1 are to be marked on OMR sheet only. OMR sheet only. And answers to questions in part 2 are to be written on descriptive type answer book. Answer to MCQs written in descriptive type answer book will not be evaluated. So whatever is there in MCQ part, that definitely we have to write in what, my dear friends? We have to write in what? We have to write in OMR sheet. Now, I want you to look at 9th point, my dear friends. Very interesting 9th point. See that? Duration of examination is 3 hours. Obviously, we know that. You will be required to submit a part 1 of the question paper containing multiple choice questions, OMR sheet thereon, and also the answer book in respect of descriptive type answer book to the invigilator before leaving examination hall after the conclusion of the exam. I'll read that line once again, friends. What is that line you see? You are required to submit part 1 of the question paper containing multiple choice questions and OMR sheet thereon, and also answer book for descriptive type. The point very clear is that after you write the exam, ICA is taking away part 1 of the question paper and also OMR sheet and also descriptive type answer book. That means what you have to understand very clearly is that ICA is not releasing the multiple choice questions outside. ICAI is not releasing the multiple choice questions outside. Come on, friends, I repeat one more time. ICAI is not releasing the multiple choice questions outside, my dear friends. Getting clarity on this point? Speak out, sir. Very good. Come on. So let's look at part 2, my dear friends. 70 marks. Let's start with question number 1, which is worth for about 14 marks. Let's discuss in detail and start solving the answer. Are we ready? Let's proceed. Sukhdev is a mining engineer. He has crossed the threshold limit of registration under GST law and is duly registered in the state of Maharashtra. Very good. Already he is registered. He effects the following transaction in the month of March 2019 and wants you to compute the tax payable in cash. He has filed the bond or annuity. He has filed what, my dear friends? Bond or annuity to claim benefits from zero rated supplies. To claim benefits from what, my dear friends? Zero rated supplies. Come on, friends. He has filed bond or annuity to claim benefits from zero rated supplies. Friends, I'll do something. Hold on for a second. Come on, hang on, guys. Come on, see now. Sukhdev is a mining engineer. He has crossed threshold limit for registration under GST law. I opened through another software so that we can underline them easily. And is duly registered in the state of what, my dear friends? Maharashtra. He is registered in the state of Maharashtra. Very good. Then what has happened? He effects the following transaction in the month of March 2019 and wants you to compute the tax payable in cash. He has filed bond or annuity to claim benefits from zero rated supplies. To claim benefits from what, sir? Zero rated supplies. That means we are talking about something called zero rated supplies without payment of output tax. Sir, zero rated supplies are those supplies on which we do not pay output tax, but we can still claim refund of input tax credits, because in zero rated supplies there are 2 types. 1, zero rated supplies with payment of tax. Number 2, zero rated supplies without payment of tax. I repeat one more time, friends. First of all, First of all, when we talk about zero rated supplies, friends, please understand, zero rated supply covers two things, my dear friends. I repeat one more time, when we talk about zero rated supplies, my dear friends, zero rated supply actually covers two things. Number one, exports. Exports is covered there. Number two, supplies to SEZ. Come on, my dear friends, zero rated supply covers two things. What is that two things, my dear friends? Exports. Other one is what, my dear friends? Supplies to SEZ. So friends, zero rated supply covers two things. That is what, sir? Exports, supplies to SEZ. And when we talk about zero rated supplies, my dear friends, there are two interesting points what you have to know. That is, for zero rated supplies, I repeat one more time, for zero rated supplies, there are two interesting points what you should have clarity of thought upon. Now what is that? Let me explain you very clearly, my dear friends. Come on, listen. So friends, when we talk about zero rated supplies, my dear friends, there are two types of categories in zero rated supplies. That is, of course, exports and supplies to SEZ. Now, when we talk about tax treatment for zero rated supplies, there are 2 points here, sir. Point number one, zero rated supplies without payment of tax under bond or LUT. Come on, friends, zero rated supplies without payment of tax under bond or LUT. In this case, what we'll do is no output tax, but refund can be claimed on input tax credit related to inputs and input services. Come on, my dear friends, very interesting and important concept. In zero rated supplies, there are two categories, my dear friends. Number one, without payment of tax under bond or LUT. When we talk about without payment of tax under bond or LUT, there is no output tax. But refund can be claimed on input tax credits related to inputs and input services. Other side, zero rated supplies, we can do something called with payment of tax. And when we talk about zero rated supplies with payment of tax, what we'll do is pay output tax and again claim refund. So friends, the difference you have to understand is that in zero rated supplies, there are two types actually. Of course, zero rated supply covers exports and supplies to SEZ, and there are two types of zero rated supply. Number one, zero rated supplies without payment of tax under bond or LUT. And when we talk about without payment of tax under bond or LUT, there is no output tax. But input tax credit can be claimed as refund, provided input tax credit is related to inputs and input services. And other side, when we talk about zero rated supplies with payment of tax, we will pay output tax and claim refund. Like this law gave two options related to zero rated supplies. Now you might ask, so what difference it makes? It makes a difference because when we talk about without payment of tax, we will not pay output tax at all. And happily we can take a refund related to ITC on inputs and input services. But when we talk about with payment of tax, we will pay the tax and then claim refund. And when we are claiming refund, we will claim refund even related to inputs, input services, and even on capital goods also. But when we talk about without payment of tax under bond or LUT, we cannot take refund related to capital goods. So there is a concept there, no fun at all. Getting clarity, friends? Speak out. Very good. Come on, next. Can I proceed, sir? I'm sure we got good clarity on this point, my dear friends. Good. Let's move forward. So friends, I'm sure we got the difference between zero rated supplies without payment of tax and zero rated supplies with payment of tax. Without payment of tax is under bond or LUT, where we do not pay any output tax and directly will claim refund on input tax credit. And that too, input tax credit only related to inputs and input services. And when we talk about zero rated supply with payment of tax, we will pay output tax and again claim refund. And the benefit in the case of with payment of tax is that we can claim refund of inputs, input service as well as capital goods. But the only drawback is that first you have to pay, then claim refund. Clear friends? But for without payment of tax, refund will come only on inputs and input services. Got clarity of thought, my dear friends? Very good. I'll go back to the question now. So going back to the question, my dear friends, see now. Yes. First point, Sukhdev. So by the way, remember Sukhdev, no? He's a mining engineer and he crossed threshold limit for registration under GST law and he registered in the state of Maharashtra. See now, Sukhdev is an operating member in mining and exploration services at Mumbai High, has provided certain services to joint venture in which he is also a participant. He believes that consideration received from the joint venture is cost petroleum and it is not taxable. Crazy point. Sir, whenever we talk about joint venture, my dear friends, first of all, joint venture is a consortium or a group of various members, my dear friends. Now what happens is that every member will contribute certain amount, which is technically called as cash calls. Cash calls is nothing but an investment made by members in the joint venture, and this cash calls is obviously not taxable. Cash calls is obviously not taxable because cash calls is not taxable because it is a cash calls is not taxable because it is a transaction in money. Obviously, my dear friends, in a company, if the share capital is invested on the share capital, why you will pay GST? Same logic, in a partnership firm, if the partners contribute capital, why firm will pay GST? On the capital, obviously you will not pay GST. But one point you have to understand is that if any member provides service to joint venture, then it is definitely taxable, my dear friends. No doubt about it. If any operating member is providing service to joint venture and they got consideration, then that is definitely taxable. We don't call it as a cost petroleum. Sir, cost petroleum story is totally different, sir. Now what is cost petroleum? Let me explain to you first of all. Sir, basically there is an exploration company who explores oil and natural gas. Now what will these guys do is, they will enter into an agreement with government. They will enter into agreement with government wherein government grants license for exploration. Clear, my dear friends? Now, exploration company undertakes exploration activity. They undertake exploration activity, and what they will do is, once petroleum crude is discovered, petroleum crude or any gas is discovered, what they'll do is exploration company will first recover that extent of petrol, otherwise they'll first take that extent of crude to recover their cost. I repeat one more time, my dear friends. Once petroleum crude is discovered, I repeat one more time, once petroleum crude is discovered, obviously it's not invented, it is discovered, exploration company will first take that extent of crude to recover their cost, and this is technically called as cost petroleum. And it has been clearly clarified by the law that this cost petroleum is not taxable because it is not a consideration. Some cost they incur and that cost has been recovered, because exploration company and government are acting as licensor and licensee. Clear, my dear friends? Then balance is regarded as profit petroleum. Come on, my dear friends, out of the total petroleum, whatever petroleum is taken away by exploration company, I repeat one more time, out of total petroleum, whatever petroleum is taken by exploration company to recover their cost, is technically called as cost petroleum, which is not taxable, and the balance is regarded as profit petroleum. And they clarify that central government share of profit petroleum is straightaway exempt under GST law. And whenever I say central government share, it is something like a consideration given for granting lease, my dear friends. So I repeat one more time, my dear friends, kindly please listen. Central government and exploration company are acting as licensor and licensee, wherein government is giving license to exploration company to engage in exploration activity. And once the petroleum crude is discovered, I repeat one more time, once the petroleum crude is discovered, exploration company will first take that extent of crude oil to recover their cost, and that is technically called as cost petroleum. And they clearly clarify that this cost petroleum is not taxable, and the balance is regarded as profit petroleum, and this profit petroleum is shared between exploration company and central government. And why central government is taking? Central government is taking because central government gave a right to carry on mining activity. Otherwise, they gave a right of lease. And since they gave the right of lease, central government will take some share. And that is basically consideration for granting the lease. And central government share of profit petroleum, I repeat one more time, central government share of profit petroleum is straightaway exempt under GST law. That's clearly given by exemption list. I'm sure we got full clarity on this point, my dear friends. Very good. Going forward, see now, Sukhdev is operating member in mining and exploration services at Mumbai High and has provided certain services to joint venture in which he is also a participant. So this 12 lakhs will definitely become taxable, my dear friends. Clear, sir? And where are we, my dear friends? We are registered in Maharashtra and we gave to somebody in Mumbai. And we can see very clearly what is that they asked? Determine tax payable in cash, supply value exclusive of taxes. Services are taxable at 9, 9, 18. Goods are taxable at 2.5, 2.5 and 5. And ours is a service, and we both are in same state. So when we both are in same state, we will charge what, my dear friends? CGST and SGST at the rate of 9% and 9%. 12 lakhs into 9%, that is coming to 1,08,000. So 1,08,000 is CGST component and 1,08,000 is SGST component. That's it. I hope we got clarity on this point. Very good. Then he has purchased certain machinery from outside the state. I repeat one more time, he has purchased certain machinery from what, my dear friends? Outside the state. He purchased certain machinery from outside the state to render service to whom, sir? To render service to joint venture at Mumbai High. Very, very interesting line. Come on, my dear friends, see that line once again. So friends, what he has done, my dear friends? He has purchased a machine from outside the state to render service to joint venture at Mumbai High. Very good. So on this, my dear friends, on this, what is the GST, my dear friends? Outside the state, right? So IGST will be 5%. On 6 lakhs, 5% comes to 30,000. And this 30,000, we will claim it as input tax credit. Correct or not? Because that is an inward purchased. Exactly. Then he has obtained a legal opinion from local firm of advocates to enter into a contract with joint venture for providing services to it. On this also, he can claim input tax credit. And on this 1 lakh, CGST and SGST will apply, which will be 9,000 and 9,000. And this 9,000, he'll claim it as input tax credit. Clear, friends? Good. Then he has obtained accommodation from what government, my dear friends? Accommodation from state government to locate his office. He has taken accommodation service from state government to locate his office close to the seashore. So what? Still GST will apply. What will come? CGST and SGST, which comes to 18,000 and 18,000. And that also he'll claim it as input tax credit. Obviously, my dear friends, whatever inward supply we have taken, definitely will take input tax credit. Next line. He gets a portion of, I repeat one more time, he gets a portion of petroleum silt. I repeat one more time, my dear friends, what is that language, sir? He gets a portion of petroleum silt as a part of compensation while exploring the petroleum reserves in Bombay High, which as per the contract with the government is a part of cost petroleum. And I clearly told you, my dear friends, cost petroleum, this is not a consideration for service. Cost petroleum is not a consideration for service. So obviously, what will happen, my dear friends? This is not taxable. Clear, my dear friends? Very good. Next line. He sells petroleum silt to a CZ developer. So when it is a CZ developer, it is called as zero rated supply. And they clearly told in the question that a zero rated supply is being provided under bond or LUT. And when it is provided under bond or LUT, on this, my dear friends, no tax will arise. No tax will arise. Then consideration is received towards transfer of tenancy rights, which according to Sukhdev is not liable to GST as it has suffered stamp duty. So one point, let me very clearly tell you that transfer of tenancy rights against consideration in the form of tenancy premium is always taxable, my dear friends. No doubt about it. Even though stamp duty is being charged, still it becomes taxable. CGST and SGST. 8 lakhs into 9%. 8 lakhs 9% comes to 72,000 and 72,000. Next. On violation of the terms, I repeat one more time, what is that language, my dear friends? On violation of terms, I repeat one more time, kindly please listen. On violation of the terms in production sharing agreement, on violation of the terms in production sharing agreement, Sukhdev has paid liquidated damages to the government. What they paid, my dear friends? Liquidated damages to the government. One point which let me tell you very clearly, my dear friends, that is, when we talk about liquidated damages to the government, listen. Friends, come on. The interesting line, what they used is that on violation of the terms in production sharing agreement, Sukhdev has paid liquidated damages to the government. One point what they told in the law is that any service given by the government and the service is tolerance of or tolerating non-performance of the contract, that service is actually exempt, my dear friends. In other words, whenever we are paying liquidated damages to the government, on that GST will not apply, because any service provided by the government, by way of tolerating non-performance of a contract is straight away exempt under GST law. Clear, my dear friends? Speak out, sir. Very good. I hope we got full clarity on this point, my dear friends. Yes, sir. Then come on. He has been assigned. One more time I repeat. He has been assigned he has been assigned the right to collect royalty on behalf of Maharashtra government as excess royalty collection contractor. So this man has been given a right to collect royalty on behalf of Maharashtra government as excess royalty collection contractor. He has noticed that mining leaseholders have short paid 2 lakhs. Have short paid what, sir? 2 lakhs as IGST from what had been exempted to him under the assignment. Clear, my dear friends? He has noticed that mining leaseholders have short paid 2 lakhs as IGST from what had been exempted to him under assignment. So obviously what will happen now? On this 2 lakhs, our hero, what a person named Sukhdev, on this 2 lakhs, Sukhdev will be liable to pay. So this 2 lakhs, Sukhdev will be liable to pay. Clear, my dear friends? Speak out. And moreover, my dear friends, this 2 lakhs will be liable to pay. Moreover, Sukhdev will be liable to pay tax under RCM, my dear friends, because whenever service is given by central government, state government, or local authority to a business entity, that is always covered under RCM. On the same lines, my dear friends, previous point also, when we talk about legal service, this legal opinion also, this is also taxable under RCM, my dear friends. And in the same language, when we talk about accommodation, that is nothing but renting of immovable property. Whenever central government or state government is giving service of renting of immovable property to a registered person, whenever central government, state government, union territory or local authority is giving service by way of renting of immovable property to a registered person, that is taxable under RCM, my dear friends. So who is liable to pay GST is nothing but Sukhdev. Next point. Come on. A very, very interesting question came in exam, which has got lot of concept with it. Getting clarity, my dear friends. Any small point can become a question in the exam. No games at all. Very interesting. Come on. He has sold self-fabricated machinery, self-made, through his agent in Mumbai. So goods are sold through agent. When goods are sold through agent, for value of supply, my dear friends, we have got one rule called Rule 29, which says that value of supply will be open market value or 90% of price charge for goods of like kind or quality. See now, that has been used for 2 years, the value of which is not available in the open market, and the agent sells it immediately to an unrelated customer in Mumbai. Clear, friends? So we don't have open market value, but we have the value at which it is sold to an unrelated customer. Clear, my dear friends? On this we will charge, on this we will say value of supply will be 90%, which comes to 9 lakhs. Which comes to what, my dear friends? 9 lakhs. Getting clarity, my dear friends? Speak out. Very good. And on this 9 lakhs, what will come is that CGST 9%, SGST 9%. So CGST will be 81,000, SGST also will be 81,000. Correct, right? But it's actually not 9%. The reason being it is machine, right? So when it's machine, they told it is 2.5. 9 lakhs into 2.5%, my dear friends. That's coming to, wait a second. 9 lakhs into 2.5%. That is coming to 22,500. So 22,500 is the CGST component. And in the same lines, 22,500 is the SGST component. Getting clarity, friends? This is basically value of supply when goods are sent from principal to agent. Are we clear with this? Very good. Next point. opening balance and the brought forward tax credits are as follows. Electronic cash ledger also some balance is there, and I hope we know that cash ledger balance we have to use only for that particular purpose. But credit ledger we can play. How we can play? CGST credit should be used first for CGST credit, CGST output, then we'll use it for output IGST. SGST, first output SGST, then output IGST. IGST, first output IGST, then we can use it for CGST or SGST in any order or any manner. Getting clarity, friends? Speak out. Very good. So friends, when we talk about input tax credit available for us, what is the input tax credit available with us, my dear friends? The opening balance what we have is something different. Then we'll also look at what is the credit what we have got. Are we ready, sir? Come on, let's do the workings and get the answer. Let's talk about input tax credit of CGST, SGST as well as IGST. Can you please tell me what is the opening figures, my dear friends? 18,000, 12,000, 60,000. That is my opening figures, opening balance of credit ledger. Correct or not? Exactly. 18,000, 12,000 and 60,000. See now. 18,000, 12,000 and next one 60,000. To this, what is the current credits what I have got? First one, purchase of machine 30,000 IGST. Correct or not? Purchase of machine 30,000 IGST credit I'll get. Come on. Purchase of machine 30,000 IGST credits. Purchase of machine 30,000 IGST credit, and then legal opinion taken on which obviously we'll pay tax under RCM and again claim input tax credit, and the figure is 9,000, 9,000. 9,000, 9,000. Renting of property 18,000, 18,000. Legal opinion 9,000 and 9,000. Then renting of property 18,000 and 18,000. Renting 18,000, 18,000. Clear, my dear friends? Come on then. What else I've got? Come on, my dear friends. What else I've got? 9,000, 9,000. Renting also we have done. Then next, what else? Alright, we have this point. Assignment of right. He has been assigned the right to collect, and there is a short payment of 2 lakhs. That 2 lakhs will pay now under RCM and again will claim input tax credits. Clear, friends? Exactly. Right to collect royalty. On this, what is the credit, my dear friends? 2 lakhs. That's it. So, my dear friends, with this, I'll get the figure of my total input tax credit. So my total input tax credit will be 18 plus 9 plus 18. 18 plus 9 plus 18 comes to 45,000. And this comes to 39,000. Last one, 2,90,000. That's it. This is what is the figures for my input tax credit, what I can claim, my dear friends. Getting clarity, sir? It's a very, very interesting and wonderful question came in exam. Clear? Done. And when I talk about my output tax, what is the output tax I've got? CGST, SGST, IGST. Come on. What the first one I've got? Let me see from starting. Service to joint venture 1,08,000, 1,08,000. Clear, friends? Come on. Service to joint venture 1,08,000 and 1,08,000. Friends, I hope you are getting clarity on this point. Clear? Come on. Service to joint venture 1,08,000, 1,08,000. Come on, going back. Next one. Debit input tax credit, CBIT input tax credit, debit also is input tax credits. Then EBIT also not taxable, FBIT also not taxable, but GBT is taxable. Transfer of tenancy rights 72,000, 72,000. Come on. Transfer of tenancy rights 72,000 and then 72,000 and 72,000. Getting clarity, friends? Then what else we had? Finally, the last one, that sale of machine 22,500 and 22,500. Clear, friends? Exactly. Sale of machine 22,500, 22,500. So what is my total output tax payable is nothing but what, my dear friends? 1,08,000 plus 72,000 comes to 1,80,000. 1,08,000 plus 72,000 comes to 1,80,000, and 180 plus 22,500 comes to 2,02,500. This becomes my, what, my dear friends? Output tax. And when I talk about input tax credit, what is that I have got? CGST 45,000, SGST 39,000. And of course, before I use these credits, first I should definitely use something called IGST credit, my dear friends. And one point very clearly is that IGST credit should be first always used for output IGST. Then we can use it for output CGST or SGST in any order and any manner. My always recommendation is that divide half of, your job becomes more easy. 2,90,000, right? 1,45,000, 1,45,000. Then ITC of CGST, how much I have got? 45,000. Then SGST, how much I have got? 39,000. I hope you are getting clarity, friends. Speak out. Very good. So 145 plus 45 is 190 is over. 190 is over. But I have to pay 2,02,500. I have got balance of CGST in cash ledger. CGST balance in cash ledger. I can use it only for CGST. How much I have got actually? I've got a balance in CGST cash ledger, 12,000 I've got. Clear my difference? Come on, how much I've got? 12,000 is what I've got. And I already have to pay, 2,02,500. When I have to pay 2,02,500, 145 is over, 45 is over. That means how much is gone? 190 is gone. Correct or not? When 190 is gone, what is the balance I've got? What is the balance I have to pay? 12,500. Correct or not? Speak out, sir. Exactly. Now, what is that balance I have got? 12,000 is only what I have got. So, what is my net payable? 2,02,500 minus 2,02,000. It comes to what, my dear friends? 500. Then 2,02,500 minus 1,45,000 minus 1,45,000 minus 39,000. This is coming to 18,500. So my net payable is 18,500 for CGST part. SGST part. CGST is 500, SGST is 18,500. So one point you have to keep in mind is that IGST credit should always be first used for output IGST. Then we can use it for CGST or SGST in any order or any manner. That is why I divided half. That is the only point. I hope we are getting clarity on this point. And moreover, apart from this, my dear friends, an interesting point what I will tell you is that taxes payable under RCM that should be paid using electronic cash ledger only. That should be paid using electronic cash ledger only. We cannot use credit ledger because whenever we have to pay some tax under RCM, we can't use credit ledger. Definitely we have to use cash ledger. Come on friends, what was that we are supposed to pay using that electronic cash ledger under RCM, friends? Come on, RCM, what all we had? First we had a point about legal opinion, 9,000. Renting of property, 18,000. Correct or not? Come on. CGST, SGST, IGST. Legal opinion, 9,000. Then renting of property, 18,000. Finally, last one, assignment of rights. For that assignment of rights, what is told, my dear friends? The figure is 2 lakhs. So therefore, this 27,000 and 2 lakhs, I have to pay using my electronic cash ledger, but I cannot use electronic credit ledger, my dear friends. Such a wonderful point actually, which makes lot of sense, my dear friends. And let me tell you very clearly, in this November 2019 paper, in exam paper, this first question was only the trickiest question. Rest all questions were very simple and easy. This was the only point which was slightly tricky. And on that point, clarity of thought is required. Rest all questions will not take much time. We will happily do it. But this is the only question which was time taking, and first question only they squeezed left and right in the exam. Are we clear, friends? That's it. That is the story of this wonderful first question which came in the exam. Now, moving forward. So friends, come on. We are done with question number 1. Now let's look at question number 2, my dear friends. Come on, look at that. Bodmas Limited, providing educational services, furnishes you the following information. Educational service, tremendous concept actually. Very wonderful. See that, come on. Receipts from running a boarding school, 30 lakh rupees, and 30 lakhs is including receipts for providing residential dwelling service. That is something like a hostel. Clear, my dear friends? Speak out. This 30 lakhs will be straight away exempt. The reason being very clearly that education institution also covers an institution engaged in providing preschool education, engaged in providing what, my dear friends? Preschool education and education up to higher secondary school. And they clearly told in the exemption list, that is, whenever they give any service to students, faculty and staff, that is straight away exempt. Because let me tell you, my dear friends, education institution is divided into 3 categories. The 3 categories are: number 1, an institution engaged in providing preschool education and education up to higher secondary school or equivalent. Higher secondary school is something like up to 12th. Number 2, an institution which is engaged in providing education as a part of curriculum for obtaining qualification recognized by the law. Number 3, an institution engaged in providing education as a part of approved vocational course. So these 3 institutions, when they are providing service to students, faculty and staff, that is straight away exempt. Next, receipts of Gyan Uday, an industrial training institute, very good ITI, affiliated to National Council for Vocational Training. Just now I told vocational training institutes are straight away exempt. Then receipts of Lakshya, an institute registered with Director General of Employment and Training under Ministry of Labour and Employment, running a modular employable skill course approved by National Council for Vocational Training. Finish. This also becomes exempt. Then receipts of Wizard, a commercial coaching institute providing commercial coaching in the field of arts and science. No certificate was given on completion. Then straight away my answer will become taxable, because exemption is given only for an institution engaged in providing education as a part of curriculum for obtaining qualification recognized by the law. If it is a commercial private coaching center, then definitely GST will apply. That is where practically when we talk about CA coaching centers, they always charge GST. Then fees from prospective employers for what, my dear friends? Campus interviews. Then this is definitely taxable. Then renting of furnished flats for temporary stay to what, my dear friends? Different persons. When we talk about temporary stay, it is something like a guest house. And let me tell you, when we talk about a hotel or guest house, something like that, exemption is only when amount charged per day is less than or equal to 1,000. Exactly 1,000 also is exempt. This is amended point, very clearly amended for your exam. Earlier they told less than 1,000 is exempt, but amendment has been done in case of hotel, inn, guest house, club, campsite, where the accommodation value is exactly 1,000 or less than 1,000 per day, then it's exempt. More than 1,000 it is taxable. Here they directly told 5 lakhs. So straight away I will tell taxable, my dear friends. Then receipts of Concepts, a commercial coaching institute providing coaching in the field of commerce. Certificate is awarded. So what? Just because certificate is given doesn't mean it is exempt. Still it becomes taxable, because the coaching center, this is not an education institution. Finally, last one, receipts of Gurukul school providing education up to higher secondary. If it is higher secondary, then straight away it is exempt. Like this one simple question that came in the exam, which is highly scoring, my dear friends. Clear, right? Done. Then be wait, guys. Mr. X has imported a machine from where, sir? Japan. He has imported a machine from Japan, very good, for 50 lakhs. However, machine was exported back in December for repairs. Supplier has agreed to carry out repairs as the machine was still in warranty, which would normally take 6 months' time. Fair cost of repairs is 10 lakhs, and in the meantime, X has requested supplier to provide him another machine so that he can carry out operations without hindrance. According to the request, supplier has provided him another machine which was imported in February, and the value of the new machine is 55 lakhs, freight is 2 lakhs, compute assessable value and duty payable. So let me tell you, whenever imported goods are exported for repairs and again re-imported, they told in the law GST will apply only on fair cost of repairs plus insurance and freight, two-way, going and coming. But here, if you observe, we did not import the same machine, but we have imported another machine. When you import another machine, my dear friends, when you import another machine, that exemption will not apply. When exemption will not apply, you have to end up paying customs duty on entire value. What is the FOB value, my dear friends? FOB value is nothing but 55 lakhs, because that is what is the value of the machine. Clear, my dear friends? Speak out. Sir, 55 lakhs becomes my value of machine. To this 55 lakhs, we all know that we will add insurance and freight. What is the insurance figure given? Insurance figure, nothing is given. If nothing is given, we will take it as 1.125% of FOB. 55 lakhs into 1.125% of FOB. It is coming to 61,875. Come on, insurance cost, since we don't know, we will take it as 1.125% of FOB. 61,875. And freight already given 2 lakh rupees. So total comes to 57 lakhs 61,875. And I hope you have understood why we have taken 55 lakhs. The reason being very clear that whenever we export something for repairs and we are re-importing again, we will actually pay customs duty only on fair cost of repairs, provided same machine is coming back. But here, same machine is not coming back, different machine is coming back, because they clearly told in the law, imported goods and exported goods both must be same. If they are different, then the benefit will not apply. What is the BCD rate? BCD is 10%, IGST 12%. SWS, of course, social welfare surcharge is 10% of BCD. Come on. So what I will charge is now BCD at the rate of 10%, which comes to 5,76,187.5. So I'll take it as 188. And SWS, social welfare surcharge at the rate of 10% of BCD, 57,619. Exactly. Total 57 lakhs 61,875 plus 5,76,188 plus 57,619. That is coming to 63 lakhs 95,682. 63 lakhs 95,682. And when I talk about IGST, that will come at the rate of 12%. 63 lakh 95,682 into 12%. That is coming to 767,481.84. I'll take it as 482. 767,482. So IGST figure is 767,482. Therefore, total customs duty payable will be equal to how much, friends? 576,188 plus 57,619 plus 767,482. Total figure is coming to 14 lakhs 1,289. That becomes my total customs duty payable. 14 lakhs 1,289. And one point you have to understand very clearly is that this story is being applied because imported goods and exported goods both are different. If imported goods, exported goods would have been same, then GST would have been applicable only on fair cost of repairs. GST would have been applicable only on fair cost of repairs. That's it. That is the story of this wonderful question. I hope we got clarity, friends. That's it. That is the story of question number 2, sir. Come on, friends. Now looking at question number 3, sir. Mr. Rajbir, a registered person at Delhi, is in the business of selling goods relating to interior decoration. Very good. Under the firm name Rajbir and Sons. Very nice. That means he's basically a sole proprietor concern. He has opted for composition scheme for financial year 18-19. Very good. His turnover for 18-19 is 80 lakhs and is expected to achieve 130 lakhs in 19-20. Discuss whether Rajbir and Sons can still enjoy the benefits of composition scheme in 19-20. 100% answer is yes, because as per section 10 composition scheme, if aggregate turnover during preceding financial year, I repeat one more time, if aggregate turnover in the preceding financial year does not exceed 1.5 crores, if aggregate turnover during preceding financial year does not exceed 1.5 crores, then current year you can opt for composition scheme. And since he is a dealer in goods, he will pay tax only at the rate of 0.5% plus 0.5% of taxable turnover. Next line. His son Karan wants to start business of providing services relating to interior decoration. That man was goods, he is want to do service. After completing PG course in interior decoration under the same firm name Rajbir and Sons with effect from 1/4/2019. So if they want to do like that, First, sole proprietorship should be converted to partnership firm. Obviously, if you want to do like that, two people first convert sole proprietorship consent to partnership firm, then obtain new PAN, then again obtain new GST registration, because once PAN will change, GST number will change. And one point very clear, let me tell you, my dear friends, in case of composition scheme, composition registered person can provide services other than restaurant. Composition registered person can provide services other than restaurant up to value of 10% of turnover in state. 10% of turnover in state in preceding 10% of turnover in state in preceding financial year, or 5 lakh rupees, whichever is higher. Now in this particular case, when the partnership firm, otherwise when the sole proprietor concern is converted into a partnership firm, it's a new entity. So where turnover is zero, turnover is zero. So 10% of zero turnover becomes zero only, obviously. That means Karan can provide service up to value of 5 lakh rupees and can still, he can provide service up to a value of 5 lakh rupees and can still continue under composition scheme. But by any chance, if you want to provide more than 10% of turnover in state or 5 lakhs, whichever is higher, then obviously what you have to do is you have to leave composition scheme and shift to regular scheme, because in composition scheme they clearly told that any person whose aggregate turnover does not exceed 1.5 crores in the preceding financial year, he can opt for composition scheme and he can still provide some other service up to a value of 10% of turnover in state in the preceding financial year or 5 lakh rupees, whichever is higher. This small benefit they gave because generally service providers cannot take composition scheme. Generally, any person who is a supplier of service, he cannot take composition scheme. That is the reason why this special benefit they gave in the law, telling that even though you are in composition scheme, still you can provide some other service up to a value of 10% of turnover in state in the preceding financial year or 5 lakh rupees, whichever is higher. Very, very interesting point. Done. I hope we got clarity on this point, my dear friends. Speak out. Very good. A small interesting question. Come on, next. Give it. See that, come on. Surya Agencies has agreed to supply goods to customers' premises. Goods valued 80,000 are taxable at 5% as it is an interstate supply. IGST is coming. It also pays freight and insurance 12,000. GTA is a registered entity and has charged 6% CGST, 6% SGST under forward charge. Compute invoice value of supply including IGST. What will be invoice value? 80,000 plus 12,000. On total, we will charge GST at the rate of 5% only. 5% only. Obviously 5% only because it is a composite supply where the principal supply is goods and freight and insurance is only ancillary. And composite supply is always taxed at the rate of principal supply. Classic example, when we go to a furniture shop and take one dining table, along with dining table, that man also provides transport service. That is a composite supply, wherein the principal supply is dining table and transport service is only ancillary. And composite supply is always taxable at the rate of principal supply. 80,000 plus 12,000 is coming to 92,000 into 5%. It's coming to what, my dear friends? 92,000 into 5%. 4,600. 92,000 plus 4,600 comes to invoice value will be 96,600. other side, what will be the invoice value including IGST if supply is under ex-factory basis? Ex-factory basis means buyer only will incur freight and insurance. Automatically what will happen then? Invoice value will be 80,000 plus 5% IGST, which comes to 80,000 5% is 4,000. So it comes to what, my dear friends? Invoice value will become 84,000. That's it. Clear with this, my dear friends? Small question, very scoring. Sometimes some question will be there which are straightforward, which are very simple, which can be answered directly without any second thought. Then C bit, come on. Look at that C bit now. During the year 2018, customs authorities have noticed that there is an increased quantity of product XYZ being imported into the country. Determine whether central government should consider safeguard duty or anti-dumping duty. So straight away let me tell you, they will definitely charge safeguard duty only, my dear friends. And the reason being very clear, sir, let me tell you that point, that anti-dumping duty, this is imposed only when export price is less than the normal price. Come on, my dear friends, I repeat one more time. Anti-dumping duty is imposed only when export price is less than the normal price. Export price is less than the what price, my dear friends? Normal price. I repeat one more time, my dear friends. Anti-dumping duty is imposed only when export price is less than normal price. But whereas safeguard duty is imposed only when there is import in high quantities, which is causing a threat to domestic market. I repeat one more time, my dear friends, which is causing a threat to what, my dear friends? Domestic market, because of huge imports. So my dear friends, in this particular question, what that government should charge is basically safeguard duty, because you see the question very clearly, they told that goods are imposed in increased quantity. So you can't, central government cannot charge anti-dumping duty, but instead they will charge safeguard duty. Clear, friends? And exemption from safeguard duty also, some cases where safeguard duty will not apply. What is that is? Number one, goods originating from developing country, and share of imports does not exceed 3% of total imports of that article into India. Getting clarity, my dear friends? Exactly. Second, goods originating, I repeat one more time, friends, goods originating from more than one developing country, and share of imports does not exceed 9% of total imports, with each country with each country does not exceed 3%. That means it is something like your ICA exam where they are telling each country should be less than 3%. Each country should be less than 3% and total should not exceed 9%. I repeat one more time, each country should be less than 3%. I repeat one more time, my dear friends, each country should be less than 3% and total does not exceed 9%. Such a great point, my dear friends. And moreover, one more special point is that safeguard duty will not apply. Safeguard duty will not apply on articles imported by 100% EOU or SEZ. EOU stands for Export Oriented Unit, SEZ stands for Special Economic Zone. So in these cases, my dear friends, there is no question of safeguard duty. Getting clarity, my dear friends? Very, very interesting and wonderful point. Are we clear with this point, my dear friends? That's it. That is what is the story of this question number 3, my dear friends. Very, very interesting and wonderful question which came in the exam. Clear? Done? So in this particular question, my dear friends, there is no question of anti-dumping duty. What will come is only safeguard duty. And moreover, safeguard duty will not apply if the goods are coming from developing country and the share of imports does not exceed 3% of total imports. And if they are coming from more than one developing country, each country should be less than 3% and total should not exceed 9%. And moreover, safeguard duty will not apply on articles imported by 100% EOU or Special Economic Zone. Clear? Exactly. 100% EOU or SEZ unit. That's it. Done. Come on, friends. Now let's look at question number 4, sir. Generally, first 3 questions only will be little big, but after that, next 2-3 questions will be very, very small and easy and comfortable. See that? Following particulars are furnished by Delight Exporters, Karnataka, which is duly registered under GST Act. Very good. NTG has also filed a bond or LUT. I clearly told you that in order to export the goods without payment of any taxes. I told this to you, sir. You are required to calculate refund amount in respect of input tax credit on inputs and input services relating to goods exported in the relevant tax period. Very good. Let's start looking at the numbers. Turnover excluding supply of services, 76 lakhs is the turnover excluding supply of services. But you need to understand that turnover 76 lakhs excluding supply of services, but includes exempt supply of 8 lakh rupees and inverse supply of 2 lakh rupees. And when I talk about turnover, obviously in turnover my inverse supplies will not come, and obviously in my turnover exempt supply also will not come. Clear, my dear friends? Exactly. Next line. Zero rated supply of goods under bond or LUT is 12 lakh rupees. Very good. Export service under bond or LUT is 48 lakhs. Fantastic. Non-zero rated supply of services 10 lakhs. That means what? This is local. Then payments received towards zero rated supply of service, which includes 12 lakhs against which services are yet to be supplied. 48 lakhs is received. 48 lakhs is received, which also covers 12 lakhs, which is yet to be supplied. That is 12 lakhs is something like an advance. And let me tell you, my dear friends, these kind of advances are not considered while calculating turnover, sir. So friends, please observe there, payments received towards zero rated supply is 48 lakh rupees, and that 48 lakhs includes 12 lakhs against which services are yet to be supplied. That means this 12 lakhs is something like advance, and this kind of advance for services is never included as a part of turnover, my dear friends. This 12 lakhs is never included as a part of turnover. This is not included in turnover, friends. Then advance received in past against which zero rated supplies have been made in the current period. This will be included. You have to get the logic there. the month in which, or the year in which, the month in which we got advance, we don't include that. But the month in which we make supply, we'll include that, because that is what the special point related to zero rated supply of services. Then turnover on which suppliers have claimed refund under 89.4A and 89.4B. These are technically called as deemed exports, my dear friends. Deemed exports. On deemed exports, if suppliers have claimed refund, then no refund allowed to, delight exporters. Then no refund is allowed to what, my dear friends? Delight exporters. Then no refund is allowed to what, my dear friends? Delight exporters. So this figures will reduce, my dear friends. Getting clarity, sir? Speak out. Very good. Then ITC on inputs and input service during the tax period, including those under Rule 89.4A and 4B. And 89.4A and 4B is how much? 2,40,000. On this, no refund is allowed. So therefore, net ITC will be 12 lakhs minus 2,40,000, which comes to 9,60,000. 9 lakh what, my dear friends? 60,000. And what is the turnover of zero rated supply of goods? Total is 12 lakhs. From that, I'll reduce 6 lakhs. Why I'll reduce 6 lakhs? Because 6 lakhs is related to 89.4A, 89.4B. What is the balance figure then? 6 lakhs. Balance figure is 6 lakhs only. Clear, my dear friends? And when I talk about zero rated supply of services, sir, zero rated supply of goods is equal to 12 lakhs minus 6 lakhs, which is coming to 6 lakhs. And when I talk about zero rated supply of services, what is the figure I'll take, my dear friends? The figure is nothing but 48 lakhs is the payment received towards zero rated supply, of which 12 lakhs is advance, we will not take into account, and 14 lakhs is advance received in past, for which we made supply now, so that we will add. So from 48 lakhs, I'll reduce 12 lakhs and add 14 lakhs. Come on, friends. From 48 lakhs, I'll repeat one more time, my dear friends. From 48 lakhs, I'll reduce 12 lakhs and add 14 lakhs. The logic being very clear that in case of zero rated supply of services, advance received at present we will reduce. Advance already received in past, for which we have done supply now, that we will add. So net effect, the figure is how much, my dear friends? 50 lakhs. Clear, friends? Speak out, sir. Very good. Therefore, adjusted total turnover. Adjusted what turnover, sir? Total turnover is 6 lakhs. Correct, my dear friends? Come on. What is the turnover, by the way? Already 76 lakhs we have done. 76 lakhs is what? Domestic kind of turnover. Exactly. And you have to observe that out of 76 lakhs, please observe, my dear friends, out of 76 lakhs, 8 lakhs is towards exempt supplies and 2 lakhs is towards, 2 lakhs is what, my dear friends? 2 lakhs is inward supplies. Getting clarity, guys? Come on. So friends, out of 76 lakhs, 2 lakhs is towards inward supplies and 8 lakhs is exempt supplies. Clear, friends? Exactly. So what I'll do now? Now what I'll do is basically, when I calculate my total turnover from 76 lakhs, I'll reduce that 8 lakhs and I'll also reduce that 2 lakhs. Clear, my dear friends? Exactly. To this, I'll also add what is my zero rated supply of goods, my dear friends? Zero rated supply of goods is actually 12 lakhs. From that 12 lakhs, how much is gone? From that 12 lakhs, 6 lakhs is gone. So what is the balance figure is only 6 lakh rupees. Clear or not? Speak out. Exactly. So friends, please understand that starting of the question they told turnover excluding supply of service. That means what? This turnover is only related to goods, and the figure they told is 76 lakhs. And below again they told zero rated supply of goods. Now it is your assumption whether you want to assume that 76 lakhs includes 12 lakhs or 76 lakhs does not include 12 lakhs. Clear, my dear friends? So let's say if I assume that this 12 lakhs is already included in 76 lakhs. If I assume that this 12 lakhs is already included in 76 lakhs, then what I'll do, my dear friends, from 76 lakhs, I'll reduce 8 lakhs, I'll reduce 2 lakhs, and I will add 50 lakhs my zero rated supply of services, plus I'll also add non-zero rated 10 lakhs, non-zero rated supply of service, that figure also is there, 10 lakhs. Non-zero rated supply of service, how much is that figure, my dear friends? That figure is basically 10 lakhs. And I'll also reduce 6 lakhs and 6 lakhs because these two are related to 89.4a and 89.4b. So this question is being solved on some assumptions. If you assume that 12 lakhs is not included in 76 lakhs, your answer will change. I repeat one more time. If you assume that 12 lakhs is not included in 76 lakhs, your answer will definitely change, my dear friends. Clear, sir? So what is my adjusted total turnover, my dear friends? Come on. 76 minus 8 minus 2. That means 76 minus 10, 66. 66 plus 50 is 116. 116 plus 10 is 126. 126 minus what? 12. It comes to 114. It comes to how much, my dear friends? 114 lakhs. Exactly. So that figure will come to 114 lakhs. Therefore, refund eligible is equal to, what is the ITC, my dear friends? Net ITC is 9,60,000. Net ITC figure is 9,60,000. Come on. Net ITC is how much, my dear friends? 9,60,000. Net ITC into zero rated turnover divided by adjusted total turnover, which comes to 9,60,000. Come on, my dear friends. How do we calculate refund eligible, my dear friends? What is the formula? Come on. Net ITC into zero rated turnover divided by adjusted total turnover. Clear, friends? Come on. So what is net ITC, my dear friends? 9,60,000 into 56 lakhs zero rated turnover divided by adjusted total turnover 114 lakhs. 9,60,000 into 56 divided by 114. So answer is 4,71,578.94. So if we round off, 471,579. 471,579. Clear, friends? 471,579. Very, very interesting point, friends. That's it. That is the end of story for this wonderful point which came in the exam related to refunds. And let me tell you very clearly, my dear friends, refunds is one such topic which is generally coming in exam almost every time. So very interesting and scoring topic. Clear with this, my dear friends? A brilliant and fantastic problem. What you need to keep in mind very clearly is that when we talk about services, we look at whatever payments we got for current period services, and we will add services what we have given for which advance already we got, and we will reduce advance we received current month. Balance figure is net figure what we will take. And of course, we will not consider supplies of 89.4a and 89.4b, which talks about deemed exports. That's it. If this clarity is there, then definitely you can answer any question, my dear friends. Done. Come on, friends. So we are done with the fourth question, A bit. Now let's look at the fourth question, B bit, my dear friends. Come on, please concentrate. Look at that question, my dear friends. Come on. Dharmadatta has taken what registration? Voluntary registration, and has not opted for composition levy. Not opted composition means what? He has taken normal registration. He is aggrieved by cancellation of his registration under GST, although he is filing nil returns as he has not conducted any business for the past 8 months. He wants to know circumstance under which PO can cancel registration on his own. Friends, let me tell you, this concept is dealt by one wonderful section called section 29, which talks about the concept of cancellation of registration. So let me tell you, section 29 deals with cancellation of registration. Which clearly says that PO may suo moto. When I say suo moto, what is meaning of suo moto? Suo moto means nothing but on his own. PO may suo moto cancel the registration. PO may suo moto cancel registration in following circumstances. Number one, very popular point. Registration is obtained. Registration is obtained by way of FMS. Registration is obtained by way of what, sir? FMS. FMS stands for fraud, misstatement, or suppression. Next. Does not conduct business. Does not conduct business from the place of business. Whatever place of business you mentioned there, please conduct business there only. But what this man is doing, he does not conduct business from what, my dear friends? Place of business. Next. Does not file, very important point actually, does not file GST returns for continuous 6 months. Does not file GST return for what, my dear friends? Continuous 6 months. Clear, my dear friends? Speak out. Next. In case of composition, returns not filed for continuous 3 tax periods. So in case of normal case, they told continuous 6 months, but composition they told returns not filed for continuous 3 tax periods. Exactly. Then next point, this is also very popular point. Voluntary registered person. Voluntary registered person did not commence business. I repeat one more time, my dear friends. What is that language say? Voluntary registered person. Voluntary registered person did not commence business within 6 months from the date of registration. He has taken registration voluntarily. Voluntarily means what? Sir, we all know that any person is liable to be registered only if aggregate turnover exceeds 10 lakhs or 20 lakhs or 40 lakhs. But a person can obtain registration voluntarily also. This man has taken voluntary registration, but he did not commence business within 6 months. Then also PO can cancel. Getting clarity, friends? Interesting point, sir. This point actually makes a lot of sense. I hope you are clear with this. Makes sense, right? Good. Going back. That's the story of B-bit. Come on. See C-bit. Mr. X imported certain goods from a related person Q of US and the transaction value has been rejected. If transaction value rejected, Rule 4, Rule 5 of the import rules are found inapplicable. Let me tell you, Rule 4 talks about something called, you look at value of identical goods. Rule 5 says, look at the value for similar goods, and they are telling Rule 4 and 5 are found inapplicable as no similar identical goods are imported in India. Mr. X furnishes cost related data. Friends, when he is furnishing cost related data, we have got one rule called Rule 8, my dear friends. See here, and request custom authorities to determine value as per Rule 8. Relevant data is cost of materials $2,000, fabrication charges $1,000, other expenses $400, indirect cost $250, freight from X factory to US port, loading charges US port, then normal net profit margin of Mr. Q is 20% of FOB. Clear, my dear friends? Then air freight from US port to Indian port. So whenever we say air freight, then whenever we say air freight, my dear friends, actual freight is restricted to what, my dear friends? 20% of FOB. Actual freight restricted to what, my dear friends? 20% of FOB. Exactly. Insurance $50, exchange rate 70 per dollar. Customs authorities are of the opinion that since value as per Rule 7 can be determined at 4 lakhs, there is no need to apply Rule 8. Can request of X be legally acceptable? 100% answer is yes. Because X can request either application of Rules 8 first or Rule 7 first. He can ask for interchanging the order of application of Rule 7 and Rule 8. So friends, first of all, if we start looking at what is the FOB value, my dear friends, FOB value is nothing but $2,000 plus $1,000, $400, plus $250 plus again $250 plus $100 loading charges. Total FOB value is coming to 2,000, 3,000, 3,400, 3,650, 3,650 plus 250, 100, 4,100, my dear friends. Correct, right? Let's check that once. 2,000, 3,000, 3,400, 3,900, 4,000. Exactly. FOB value is $4,000. Clear, my dear friends? Speak out. Exactly. Now, if you look at the story, my dear friends, when we start solving this question, what we try to do very clearly is something like this. First of all, what is the cost of materials, my dear friends? $2,000. Cost of materials $2,000. Then, come on. Cost of materials $2,000. Then fabrication charges, how much, my dear friends? $1,000. What else is there? Other charges $400. Other charges $400. Indirect expenses $250. Total is coming to $3,650. That's all. This is my what, my dear friends? Cost at Q's factory. Cost at Q's factory is $3,650, my dear friends. Speak out, sir. To this cost, I have to add something called profit margin. And what is the profit margin they told, my dear friends? Profit margin they told is 20% of FOB. 20% of what, my dear friends? FOB. Speak out. Everybody, sir. 20% of FOB. So if I go back, my dear friends, what is the profit they told? Profit margin they told us 20% of FOB value. And this $4,000 what we got is FOB value excluding profits. Correct or not? Because that profit is not added. Correct or not, my dear friends? So profit is 20% on FOB, or other words 25% on cost. That is 25% on $4,000 I clearly told you the working for $4,000. Clear, friends? $4,000 has come because we added that freight and loading charges. Clear, everybody? Exactly. Because freight is 20% of FOB, and that FOB figure of $4,000 is excluding FOB figure of $4,000. I repeat one more time. FOB figure of $4,000 is excluding profits. So when 20% is on FOB, including profit, 25% will be on cost. So that becomes $1,000, my dear friends. Clear, sir? Speak out to this. I will add what, my dear friends? Insurance. How much is insurance? Insurance is $50. Correct or not? Insurance, how much, my dear friends? $50. Insurance is $50. Come on. Finally, air freight 20% on FOB. In fact, wait a second. Insurance, how much, sir? $50. Air freight 20% of FOB. That is 20% on $5,000. Obviously, because my FOB value is including profit, that is $5,000. Because $4,000 is before adding profit margin, and after adding profit margin it is $5,000. That's coming to $1,000, my dear friends. So total assessable value is how much, my dear friends? 3650 plus 1000 plus 50 plus 1000. It's coming to 5,700 into what is exchange rate, my dear friends? 70 per dollar. 3,99,000. 3 lakh what, my dear friends? 99,000. Getting clarity, friends? Speak out. So assessable value is nothing but $5,700, my dear friends, into 70 per dollar, and that was coming to 3,99,000. That's it. The working has been done like this for a simple fact and reason that whenever goods are imported by air, actual freight is restricted to 20% of FOB. And when I say freight covers transport charges, loading charges, handling charges, right from Q's factory till the time goods reach India. Come on, my dear friends. To give a note, what I can tell you is that in case goods are imported by air, actual freight is restricted to 20% of FOB. And let me tell you very clearly, my dear friends, when I say actual freight, it covers transport, loading, handling charges from Q's factory till place of importation. Q's factory till place of importation. That is what is the point you have to understand very clearly, my dear friends. I repeat one more time. Whenever goods are imported by air, I repeat one more time, my dear friends. Whenever goods are imported by air, when goods are imported by air, actual freight is restricted to 20% of FOB. And when I say actual freight, it means transport, loading, unloading, handling charges from Q's factory till the place of importation. Q's factory till the place of importation. That is what you have to observe, my dear friends. It basically covers from Q's factory till the place of importation. That's it. Very, very beautiful and wonderful problem, my dear friends. Clear? Done? Now, friends, looking at question number 5. a taxpayer has suppressed certain facts resulting in short payment of tax. He has suppressed, when he suppressed, we are talking about something called fraud, misstatement and suppression. Mistake is pointed out by the department, but no show cause notice has been issued so far. And as per the taxpayer, suppression is accepted at 12 lakh rupees. So 12 lakh rupees tax has been suppressed, and he agrees that suppression has taken place in the month of January. And he clears the dues from when, my dear friends? Cleared the dues on 20th of April 2019. I repeat one more time, he cleared the dues on 20th April 2019. Clear, friends? However, the department on verification identifies additional suppression of 2 lakhs in the same month for January. Show cause notice is issued and taxpayer represents before the officer, which results into an adverse order, and the order is passed on 25th of May, and taxpayer complies with the order on 27th June. 25th May order is given, 27th June the taxpayer has complied. Determine tax, interest and penalty at each stage. So friends, basically we need to calculate the figures on 12 lakhs also, 2 lakh rupees also. Come on, if I start working out, my dear friends, come on 12 lakh story, what will be the interest, my dear friends? Interest will be 12 lakhs into what rate? 18%. In how many days? Sir, they clearly told in the question that suppression has taken place in the month of January. So when I say in the month of January, that could be in January return. That could be in January return, and in January we will file the return on 20th of January. So we'll start calculating interest from 21st January. But if you assume that it is related to January month, then for January month the return is filed in 20th of February. Then interest will start from 21st February. It's your assumptions what you have to take and solve the problem. Here, let's say, if I assume that suppression taken place in the month of January, that means I'll assume that in the return filed in January, so interest will come from 21st January to 20th April, which comes to 12 lakhs into 18% into how many days, my dear friends? Jan becomes 11 days, February becomes 28 days, March becomes 31 days, April 20 days. Come on, 21st January, right? So January 11 days, February 28 days, March 31 days, here 20 days. Total 90 days. 90 divided by 365. Divided by 365. 12 lakhs into 18% into 90 divided by 365. So figure is coming to 53,260.27. So rounding off, the answer is, my dear friends, 53,000. What's that? 53,260. Speak out. Exactly. Come on. Interest will come to 53,260, my dear friends. 53,260. And we all know the fact that as per section 74, I repeat one more time, as per section 74, as per which section, my dear friends? 74, there will also be a penalty, my dear friends. And if you pay before notice, penalty is 15% of tax. So it becomes 15% of 12 lakhs, which comes to 1,80,000. This is a story related to 12 lakh rupees. And I assume that the suppression happened in the return which is filed in January month. But if you assume that suppression relates to January month, then interest will start from 21st of February. That's only an assumption what you have to take and then write properly. Because in question they did not give clarity. They only told that suppression has taken place in January month. So is it related to January month return or is it related to January month supplies? They did not give clarity, guys. Done. And when we talk about 2 lakhs, this 2 lakhs is paid after 30 days. When it is paid after 30 days, my dear friends, penalty will be is equal to 100% of tax, which comes to 2 lakhs. And apart from that, on this 2 lakhs, you have to pay interest also. What is the interest, friends? 2 lakhs into what percent? 18% into, from which period, sir? From 21st January to 27th June. 27th June. So 21st January means 11 days in Jan, 28 days in February, 31 days in March, 30 days in April, 31 days in May, 27 days in June. 158 days. 100 and what, sir? 58 days. 2 lakhs into 18% into 158 divided by 365. 2 lakhs into 18% into 158 divided by 365. That is coming to 15,583.5. I'll take it as 15,584. And the answer is being given like this, based on the assumption that there was a default done in the return of January month. If you take an assumption that it is related to supplies of January month, then interest will start from 21st of February. Your assumption will change your answer. Clear, friends? Done. B-bit, come on. See that. Ganesh Enterprises is a registered supplier under GST law, has committed an offence that is what, sir? Compoundable. Come on, friends. Just a second. Let me open that once again. Ganesh Enterprises, a registered supplier under GST law, has committed an offence which is compoundable. Let me tell you, the story of compounding is given by section 138. Department has instituted prosecution against proprietor of Ganesh and is of the opinion that he shall not be able to apply for compounding as prosecution has been launched. Now let me tell you, even though prosecution has been launched, still he can apply for compounding, my dear friends. And let me tell you very clearly, when I talk about compounding, my dear friends, compounding concept is given by section 138. Which section, my dear friends? 138, which clearly says that minimum compounding fee would be 10,000 or 50% of tax, whichever is higher. Other side, maximum compounding fee is 30,000 or 150% of tax, whichever is higher, my dear friends. Speak out, sir. Sir, getting clarity, everybody? So what is the compounding minimum, sir? 10,000, 50% of tax, whichever is higher. Maximum 30,000 or 150% of tax, whichever is higher. Very, very important concept, guys. Done? Makes sense, right? Come on. Going back to the question. C-bit, come on, see that. What is interesting, C-bit? Mr. X, an Indian resident who was on a visit to China, returned after 6 months. She was carrying with her following items: personal effects, no duty, laptop computer. One laptop is straight away exempt, my dear friends. Jewelry taxable, music system also taxable. Total is 1,25,000. From that 1,25,000 we can take rule 3 benefit of 50,000. Balance figure is 75,000. On this 75,000 we will pay duty at the rate of 38.5%. 38.5% is because 35% is the rate of duty of baggage plus 10% social welfare surcharge on the duty. So that's where it becomes 38.5%. 75,000 into 38.5%. That is coming to 28,875. 28,875 becomes the duty payable, guys. 28,875. That's it. This is what is the story of this wonderful Question number 5, my dear friends. Come on, getting clarity, guys? Very good. Come on, see next question. Mr. Pankaj. Come on, friends. Mr. Pankaj, an unregistered person under GST, purchases goods supplied by Raman, who is a registered person, without receiving a tax invoice. That means you are trying to help that person and thus helps in tax evasion. What disciplinary action may be taken by tax authorities? What they can do is, we have got one section called section 122, especially 122 subsection 3, which says penalty is up to 25,000. Penalty is up to what, my dear friends? 25,000. Clear, my dear friends? Moreover, under section 132, there can be imprisonment also. And how much will be imprisonment? Listen here. If tax evaded is more than 500 lakhs, then it is up to 5 years and fine. More than 200 lakhs, does not exceed 500 lakhs, then it's up to 3 years and fine. More than 100 lakhs, does not exceed 200 lakhs, then it's up to 1 year and fine. Getting clarity, friends? And for every second and subsequent offence, for every what, my dear friends? Second and subsequent offence, up to 5 years and fine. That's it. These 2 points you write in the exam, you will get your marks. No doubt about it. Very, very simple and very, very scoring, my dear friends. Clear with that, sir? Done. That's the story of this wonderful point, my dear friends. Clear? Done. B-Bit. Neurological Systems Private Limited has been subject to confiscation of goods on the ground that it has not accounted for the goods that are liable to tax. Directors would like to know, come on, see that? Directors would like to know from you as to how goods are to be got released. If you want to get released, my dear friends, you can pay something called fine under one section called 130, which says that maximum fine will be market value of the goods. What, my dear friends? Market value of the goods minus tax chargeable. Market value of the goods, market value of the goods minus tax chargeable. That becomes what, my dear friends? Maximum fine. Because per section 130, there is something called fine in lieu of confiscation. If you don't want them to confiscate your goods, you can pay fine. And the fine will be market value of the goods minus what, my dear friends? Tax. Clear, my dear friends? Speak out. And of course, you have to pay tax, you have to pay interest, you have to pay penalty, and you should also pay fine. Only then they'll release the goods. Clear, friends? You have to pay fine, you have to pay tax, you have to pay interest, you have to pay penalty. Clear, friends? Speak out, sir. Done. Then enumerate any 5 matters on which GST Council may make recommendation under Article 279A. Wonderful point, my dear friends. Article 279A talks about GST Council, in which there are central members and also state members. Central has got one weight of 1/3 and all state members have got weight together of 2/3. But to pass a resolution, there should be a 3/4 majority, friends. Clear, friends? Now let me tell you what are the matters. Basically, something like taxes subsumed in GST, rate of tax. Clear, friends? Rate of tax, come on, friends. Taxes subsumed in GST, rate of tax, threshold limit, or exemptions if any, or any special provisions for special category states. That's it. You write like this some points, you will get your marks. No doubt about it. Clear, my dear friends? Everybody, sir? Speak out. Very good. Next. Finally, last question. See that, come on. PQR has imported used wearing apparel from USA in April 2019. After receipt, PQR is doubtful that apparel may not be saleable in India and want to re-export back to USA without use. This point is very important. Which supplier has accepted? Will PQR be eligible to take duty drawback? 100% answer is yes, my dear friends. Moreover, you will get a drawback of 98% of duty because of section 74 subsection 1. And the conditions is that you have to export within 2 years. You have to export within how much time, my dear friends? 2 years. That point is very important. Within 2 years from payment of duty, you have to export, my dear friends. Speak out, sir. And one more very important condition is that goods must be identified. Goods must be identified to the satisfaction. Goods must be identified to the satisfaction of proper officer. Goods must be identified to the satisfaction of proper officer, and they have to be exported within 2 years. And 2 years from when? 2 years from date of payment of 2 years from date of payment of import duty. That's it. If it is without use, let me tell you, my dear friends, straight away duty drawback will be 98%. But let me tell you, in case of wearing apparels, if we export after use, then drawback will not be allowed at all. Very, very interesting concept. That's it, my dear friends. That is the end of this wonderful paper called Past Exam November 2019 paper. A very brilliant and fantastic paper. I hope we got full clarity on this point. Very good. Done. That's the end of the story for November 2019 paper. Thank you so very much, and I happily, strongly believe that you guys got some good clarity on this November 19 paper, my dear friends. Thank you so much. Bye-bye. Thank you.
If you like this video, share it with your friends. Subscribe to our YouTube channel to watch more such videos and learn from our expert faculty members. Press the bell icon to get regular notifications whenever we upload a new video. Download NDI mobile app to get complete CA course online. We value your support. Thank you for watching.